Have you ever sat quietly in the late afternoon with golden sunlight spilling through the window and wondered, what if I had started earlier? On a well known investment forum, someone once shared a story that I couldn't stop thinking about. They wrote, I didn't start investing until I was 38. I thought I was doing the right thing by saving money in a bank account. But now, looking back, I realize I've lost hundreds of thousands of dollars just because I was scared and kept putting it off. There was something in that confession that felt deeply familiar. If you're 25, 30, or even 40, and you haven't started investing yet, you're not alone. So many people in America, especially millennials and Gen Z, carry quiet worries about money. But they wait because they're afraid of losing it, because they don't fully understand investing, or because they're waiting for the perfect time. But the cost of waiting doesn't arrive with a warning. It doesn't knock on your door or send you a bill. It slips away quietly, day by day, month by month, taking with it your most powerful financial ally, time and compound growth. This video isn't here to make you feel regret. It's here to show you, no matter where you are on your financial path, there's still time. And sometimes one small decision today can completely change your future 30 years from now. So are you ready to take that first step with me? There are two people, both living in the U.S., both starting from a similar financial place, but simply because they began at different times, their financial futures went in completely opposite directions. The first, let's call her Elena. At 25, she had just graduated and landed her first job at a small design firm in Denver. Every month, she set aside $200 to invest in an S&P 500 index fund. She lived in a tiny studio apartment, drove an old Mazda, and often wore oversized t-shirts with faded jeans. No one around her talked much about investing. Some friends even said, wait until you're making more money. But Elena kept going because she believed in one simple truth: time is your money's best friend. 10 years later, someone else, let's call him Brian, started doing the same thing. At 35, Brian had a stable job in Dallas, drove a used SUV, wore plain polo shirts, and checked his digital watch between meetings. He also began investing $200 a month. But unlike Elena, Brian had spent years waiting to understand more, waiting to earn more, waiting to feel ready. They both invested consistently until age 65, but when retirement came, Elena's portfolio had grown to over $613,000, Brian's around to $277,000. Why? Elena simply started 10 years earlier, and those 10 years, though they may not seem like much, created a difference of over $335,000. The lesson here isn't about who was smarter or who earned more. It's about how time quietly turns small habits into massive results. Imagine, if Elena planted her financial seed at 25, by the time Brian started, her tree had already bloomed, while he was just holding the first seed. If you see yourself in Brian, that's okay, because there's something more powerful than starting early. It's starting the moment you realize you should. But why do so many of us wait, even when we know better? What are we afraid of, and what exactly are we waiting for? Let's explore that next. You know what's interesting? Most of us know that the earlier we start investing, the better. That information is everywhere, on TikTok, in finance books, from experts on YouTube. So why do we keep waiting? I remember someone I know, let's call her Marissa. At 32, she had a stable job in Seattle, lived in a small apartment with her lazy cat Milo. Every morning, she took the bus to work holding a black coffee and a worn-out canvas tote. On her phone, the Robinhood app was right on the home screen, but she never actually used it to invest. Marissa wasn't uninformed. She had read about investing. She even had notes on her favorite ETFs. But every time she was about to start, she told herself, I'll invest once I pay off my student loan, or after my year-end bonus, or I don't know enough yet. What if I lose money? Those thoughts sound reasonable, but underneath, they're just fear in disguise. Fear of being wrong, fear of losing, fear of not being good enough, fear of being the only one who doesn't know what they're doing. This isn't just Marissa's story. It's the story of millions of smart, capable young people in the U.S., held back by something invisible: procrastination dressed up as logic. There's a name for this mindset: paralysis by analysis. You overthink so much, you don't act. Or the perfect timing trap. always waiting for the ideal day, not realizing that day may never come. The hard part is, the longer you wait, the more it feels like you're falling behind, and then you wait even more, hoping to catch up. And the cycle continues quietly, like the steady drizzle in Seattle, soft, constant, and enough to keep you stuck without even noticing. The lesson here? Action doesn't need to be perfect, it just needs to happen. One small step, like opening an investment account or putting in your first $50, might be the first piece that changes the whole game. And if you're wondering, is it too late to start? The next part will show you that even starting at 30, 40, or 50 can still make an incredible difference. Because the question is no longer when to start, it's how you'll begin. There's a simple rule that anyone starting their investment journey should know. It's called the Rule of 72. It's not a complicated math formula, but more like a key that unlocks how powerful compound interest truly is, in a way you can actually see without needing a calculator. Here's how it works. If you want to know how long it'll take for your money to double at a given interest rate, just divide 72 by that annual rate. For example, if you're earning an average 7% return per year, 72 divided by 7 gives you about 10.3 years. That means your money will double in just over a decade without you doing anything except letting it sit and grow. I remember explaining this rule to a friend once. Let's call him Daniel. He was 30 at the time, had never invested before, and believed only the wealthy could really build wealth. So I drew a quick chart for him. At age 30, invest $5,000. By age 40, it becomes $10,000. By 50, $20,000. And by 60, $40,000. He stared at it for a moment, then said, "So, if I start late, I miss an entire doubling?" Exactly. And that's the quiet cost many people never see. Not money stolen or lost, but opportunity never taken. The chance for your money to grow silently in the background. That's the magic of compound growth. It doesn't rely on your intelligence or require expert-level knowledge. It only asks for time. And time is what we spend every single day. Think of it like a seed. If you plant it early, it has the chance to sprout, grow tall, and bear fruit year after year. But if you hold on to it, waiting for the perfect soil or weather, it'll never become a tree. So here's the simple lesson. Once you understand the Rule of 72, you can begin to see your financial future, not just feel it. A small decision today, like investing $100 a month, could double 4 or even 5 times if you start early. And if you're wondering, what happens to people who didn't start as early as Elena? In the next part, we'll hear some honest reflections from those who carry regret and those who are finding ways to make up for lost time, even if it's a little late. There's a silent enemy that's always there. You don't see it, you don't hear it coming, and most of the time you don't even notice until it's too late. Its name is inflation. Imagine you have $1,000 sitting in a savings account. Each year, the bank gives you around 1% interest. That might sound okay until you realize the average inflation rate in the U.S. is about 3 to 4% per year. That means prices are going up 3 to 4% annually, while your money is only earning 1%. The result? You're not saving money, you're losing money, slowly, every single day. I remember an old neighbor, let's call him Mr. Tony. He'd been retired for over a decade and was proud to say he had $50,000 safely in the bank. "My money's safe," he told me. "I don't need to invest and take risks." But over time, he started to notice something. Each trip to the grocery store cost a little more. His annual checkup fees went up. Even his morning coffee, once $1.50, was now $3.25. He wasn't losing money in a big, dramatic way, but bit by bit, his purchasing power was shrinking. That's how inflation works. It's not like a stock market crash that grabs headlines. It's slow, quiet, steady, like water wearing down stone. And if you let all your money sit in a savings account, you're letting it slowly die over time. Inflation teaches us this. Safe doesn't always mean smart. Sometimes what seems risky, like investing in an index fund, is actually what protects the true value of your hard-earned money. If you invest and earn 7% a year and inflation is 3%, you're still growing your money by 4%. But if you do nothing and your savings only earn 1%, you're falling behind year after year, just because you didn't act. The small lesson here: investing isn't just about getting rich, it's about not becoming poorer over time. So if inflation is the quiet enemy, then what can we do, especially if we're starting late? In the next part, we'll hear honest reflections from those who've made mistakes and are now trying to make things right. Because sometimes it's only after being late that we truly understand the value of starting. There are certain truths you can only fully understand when you hear them from someone who's lived through them. Theory may speak to the mind, but real stories speak to the heart. I still remember a Reddit post from a 53-year-old man. Let's call him David. In his post, he shared his financial journey like a quiet confession. I don't regret what I spent. I regret not believing in compound interest earlier. David used to think you should only invest when the market was just right. He passed on countless opportunities, always waiting for the perfect dip, the right sign, or simply out of fear. But time doesn't wait, and by the time he started investing seriously, he was already in his mid-40s. Today, he has a decent portfolio, but he knows if he had started just 10 years earlier, he could have retired by 50 instead of still working to stay afloat. Then there's Elisa, now 40, who started investing just 2 years ago. In a post on a financial Facebook group, she wrote, "I didn't lose money. I lost time and confidence. I spent almost a decade overthinking and doing nothing." Elisa began with a simple plan, auto-investing $250 a month into an S&P 500 index fund. She wasn't aiming to get rich quick, but month by month, step by step, she started to feel something return. Not just trust in money, but trust in herself. Stories like David's and Elisa's are not rare. On forums, podcasts, and online communities, there are thousands of similar reflections. Some people started at 35, some at 50, and some only after retirement realized the power of starting early. But what do they all have in common? None of them blame life. They just wish someone had told them this sooner. And maybe you're hearing it now at just the right moment. The takeaway here? Don't wait until regret pushes you to act. Those who've delayed don't want you to repeat their path. They simply hope you'll know better and choose differently. And if you're still asking, is it too late for me to start? In the next part, we'll look at what's actually possible, the numbers, the strategies, and the small changes you can make today to close the gap and move forward with clarity. One of the biggest reasons people delay investing isn't because they don't have the money, it's because they think they're not ready. And in that mindset, many fall into the same mistakes, repeated generation after generation. The first common mistake is, I need to learn more before I start. Maybe you've been there too, spending hours watching videos, reading blogs, analyzing the market, but never actually investing a single dollar. A friend of mine, let's call her Linda, 28 years old, read more than 10 personal finance books. She understood the theory well, knew what ETFs were, how dividends worked. But when it came to taking action, she froze. She told me, "I'm afraid I'll choose the wrong thing and lose it all." But the truth is, you'll never learn everything before you begin. It's like swimming. You can read hundreds of pages about technique, but until you jump in the water, you won't really know how to swim. The second mistake is, I don't have enough money. But investing isn't just for the wealthy. It's the tool that helps you build wealth. A former coworker of mine, Mark, used to think he needed $5,000 before he could start. Then he realized just $50 a month, cutting back on a few takeouts or one unnecessary purchase, was enough to begin building his future. What matters isn't how much you have, but whether you've built the habit of investing consistently. The third mistake is, I'll wait for the market to go down before I buy in. This is a common psychological trap. People want to time the market, but they forget that time in the market matters far more than timing it. Waiting often means missing out on years of valuable compounding. One study found that even if you invested on the worst day of the year every year for 40 years, you still came out ahead, simply because you stayed in long enough. And finally, I'll start when I make more money. But the truth is, as your income rises, so do your expenses. And if you don't build the habit of investing while you have little, chances are you won't do it when you have more. All of these mistakes come from the same root, waiting for perfection. But the truth is, perfection doesn't exist. Action, commitment, and learning through experience are the only real ways to move forward. So if you've fallen into any of these traps, don't blame yourself. We all start somewhere. What matters most is that you start now. And in the next part, you'll see how, even if you're starting late, there are real, powerful ways to catch up and maybe even move faster than you think. If you're 35, 40, or even 50, and you're thinking you've missed your golden window to invest, I want you to pause that thought. Because the truth is, you can start late and still reach financial freedom as long as you have the right strategy and a serious commitment. The biggest difference between someone who starts early and someone who starts late is time. So to make up for it, you'll need to adjust three things: your monthly contributions, your investment tools, and your working timeline. For example, if someone like Liam started investing at 25 with $200 per month, you, starting at 35, could aim to double that to $400 per month to catch up. It might sound like a lot, but it's often possible with small changes: cutting one or two unnecessary expenses, automating your investments, and treating investing like a fixed monthly bill. Another powerful move is using tax-advantaged accounts like a 401k, Roth IRA, or traditional IRA. These tools not only help you save on taxes, but they also allow your money to grow faster. And if you're over 50, you're allowed to make catch-up contributions, meaning you can invest even more each year to shrink the gap. You can also adjust your portfolio by increasing your stock allocation during your early years of investing, which raises your potential returns, even if there's some short-term risk. A friend of mine, Amanda, 42 years old, used to fear risk. But when she realized time wasn't on her side, she shifted her portfolio from 40 to 70% stocks and began investing consistently. After just 5 years, she had built up far more than she ever expected. And if you still feel like you can't quite catch up, there's another option: extend your working years by just a few more. It might not sound ideal, but even working 3 to 5 extra years while continuing to invest and delaying Social Security can significantly increase your savings. More importantly, it gives you back a sense of control over your life, instead of feeling like time is working against you. The lesson here isn't just better late than never. It's that starting late can still be powerful if you act with focus and intention. And if you're wondering, what would it look like if I started today? The next part will show you. We'll break it down with real numbers, real timelines, so you can see what's truly possible when you begin now. Getting started is always the hard, especially when it comes to investing. We all know we should be doing it, but every day brings a new reason to wait. Too busy, too tired, not enough money, not enough knowledge. But what if, in just 3 weeks, you could lay the foundation for your entire financial future? That's why the 3-week investing challenge was created, to help you take action today in the simplest, most gentle way possible. The first week is all about understanding yourself. Sit down with a blank sheet of paper or a spreadsheet and ask, how much money do I really have left after all essential expenses each month? The goal isn't to invest a huge amount right away. It's to find a realistic number you can commit to monthly, even if it's just $50 or $100. At the same time, if your employer offers a 401k match program, look into it. That's free money waiting for you. In the second week, it's time to take real action. Opening a Roth IRA or traditional IRA takes about 15 minutes online. Platforms like Fidelity, Vanguard, or Charles Schwab make it easy. Not sure where to invest? A simple S&P 500 index fund is a great place to start. Low cost, time-tested, and beginner-friendly. Don't wait until you know everything. Just pick a clear starting point and set up automatic monthly contributions. Week 3 is where you optimize and stabilize. If you can, slightly increase your investment, even just by $10. Start building your emergency fund alongside your investments. Just $1,000 to give yourself peace of mind. And begin learning about asset allocation. In simple terms, how to divide your money between stocks, bonds, and cash in a way that fits your age and risk tolerance. A friend of mine, we'll call him Chris, followed this exact path a year ago. He was 34, had never invested before and always thought, it's too late for me. But with just $200 a month, a simple index fund, and an automated plan, Chris no longer panics when he reads the financial news. He knows he's moving in the right direction because he finally started. And in the final part of this video, I want to speak directly to you, to the future you're building. There's no such thing as a perfect starting point. What there is, though, is a decision moment, like today, when you choose to begin. So are you ready? Imagine yourself at 65. It's a crisp autumn morning. Gentle sunlight spills through the window of the little house you now fully own. A warm cup of coffee in your hand. You glance at your phone, and your investment account shows a number beyond anything you once thought possible. No more bills to stress over. No more working out of obligation. You work only if you want to. And most of all, you thank your younger self for choosing to start. You see, most people in their 30s or 40s believe they're too late. But then one day, they make a quiet decision. They won't let fear take the wheel anymore. They don't wait for the market to be perfect or to know everything or to earn six figures. They simply begin with $50, $100, and a small promise to themselves, I won't wait any longer. A friend of mine, let's call him David, started investing at 45. He used to feel embarrassed, like even defeated, seeing others far ahead. But then he realized, comparison only slows you down. He couldn't go back and change the past, but he could still create a different future. Today, David has built over $300,000 in just 15 years, not through luck, but through consistency and quiet determination. Your starting point doesn't matter nearly as much as whether you start at all. No amount is too small. No age is too late. Every day you take action is a day you reclaim your future. And if you've made it to the end of this video, maybe something inside you has already shifted, a quiet seed of change, of belief, of a new journey. So let the next video on this channel be your next step. We'll explore simple, effective, and practical investment tools and long-term strategies that truly work. Remember, the best time to invest was 20 years ago. The second best time is right now.